You've probably heard the old advice. Invest $50 a week, and by the time you're 65, you'll be a millionaire. For many, that's still a viable path. But it's not the only path, and it's certainly not the fastest. Today's young millionaires aren't just playing the long game. They're running a completely different playbook, and I'm about to show you exactly what's in it. The old playbook for building wealth, save 10%, buy blue-chip stocks, and wait decades, is being rewritten. In a world of digital currencies and instant global connections, a new generation of millionaires thinks differently about risk, opportunity, and technology, allowing them to build wealth at a pace that was once unimaginable. So if you feel like the traditional path is too slow, you're in the right place. We're about to break down the exact strategies they use with income, real estate, and their portfolios to build fortunes smarter and faster. Section 1. The Income Myth. The old rule: save and invest 10% of your paycheck. The first piece of classic advice we all learn is to save, save, save. From our very first job, we're told to set aside 10% of our paycheck in a 401k or index fund and let compound interest work its magic. It sounds responsible, and it is. But for those looking to build significant wealth quickly, it can feel like a recipe for mediocrity. Let's be honest. If you're making $50,000 a year, 10% is $5,000. Even with a great 10% annual return, which is never a guarantee, it's tough to generate life-changing wealth in a short time frame. You're playing a game of slow, steady gains. The new generation of wealthy investors sees a flaw in this. It focuses on saving from a limited income instead of dramatically expanding the income itself. The principle of saving is solid, but the ambition on the income side of the equation is often what's missing. The new rule: build a cash flow engine first. Here's the reality. Many young millionaires don't start by pinching pennies. They start by building a river of cash flow. For them, a primary focus isn't just on saving their way to wealth. It's on earning their way there. For many, entrepreneurship is one of the most powerful wealth engines. This doesn't always mean launching the next billion-dollar tech company, but it does mean prioritizing income generation. This could be through a primary business, a scalable side venture, or developing high-income skills like coding, AI strategy, digital marketing, or high-ticket sales. The goal is to create a major cash surplus, not just a few $100s a month, but thousands. This cash flow then becomes the fuel for their investment machine. They often see their ability to earn as their single greatest asset and invest in it relentlessly before they start fine-tuning their stock portfolio. The how-to: become an income-generating machine. So, how can you apply this? Try shifting your focus from "how much can I save" to "how much can I earn?" First, do an honest audit of your skills. What are you good at that the market will pay for? Can you turn that into a freelance service or a consulting gig? Second, if you're in a traditional career, the mission is to become so valuable that your income potential skyrockets. This could mean getting certifications or mastering new tech in your field. While your peers might be setting up a 10% automatic transfer, you could be investing in a course or workshop that could help double your salary in a few years. Third, think about starting a side business, even a small one. It teaches you sales, marketing, and operations. Whether it's an e-commerce store or a local service, the goal is to create an income stream separate from your job. This cash is your investment accelerant, money you can afford to put into higher reward opportunities without risking your financial security. If you're enjoying this video, be sure to hit the like button and subscribe. It signals to the algorithm that we're delivering real value and ensures you won't miss the rest of our wealth-building strategies. Section 2. The Real Estate Myth. The old rule: your home is your biggest and safest investment. For generations, owning a home was the peak of financial security. The advice was straightforward: save for a down payment, get a 30-year mortgage, and slowly pay it off. Your home was your nest egg. And while home ownership is still a wonderful goal, many young millionaires view this traditional approach as inefficient. The issue with seeing your primary residence as your main investment is that it's an illiquid asset that, in the short term, can feel more like a liability It doesn't generate cash flow. It consumes it through property taxes, insurance, and maintenance. While it may appreciate, you don't see those gains until you sell. Many financial advisors consider your home an asset, but some investors argue that if it's not putting money in your pocket, it's more of a personal expense than an investment. The new rule: real estate is a cash flow business. Today's young, wealthy investors don't just see real estate as a place to live. They see it as a business. It's an asset class designed to generate monthly income and provide tax advantages. Their focus is on cash flow first and appreciation second. They often use strategies like house hacking, where you buy a multi-unit property, like a duplex or triplex, live in one unit and rent out the others. Ideally, the rental income covers the mortgage and expenses, letting you live for free while building equity. Other strategies include building a portfolio of rental properties or strategic flipping. The key difference is the shift from passive ownership to active, income-focused management. The how-to: start thinking like a real estate investor. You can adopt this mindset right now. First, change your search criteria. Instead of just browsing for your dream single-family home, start looking for duplexes, triplexes, or homes with a rentable basement suite. Run the numbers. Use an online rental property calculator. Would the property be cash flow positive? Make that your main focus. Second, if direct ownership seems like too much, look into real estate investment trusts, or REITs. You can buy shares in these companies just like stocks, giving you a piece of a large portfolio of properties without the headaches of being a landlord. Third, check out real estate crowdfunding platforms. These sites let you pool your money with other investors to buy fractional ownership in larger projects, from apartment buildings to commercial developments. It's a way to get into high-quality real estate deals with a much lower barrier to entry. Now, you might be thinking this all sounds great in theory, but what I've seen from my own experience and from talking to other successful young investors is that this shift in mindset is a huge factor. The people who break through aren't necessarily abandoning the old rules, but they are adding new ones. They build systems for generating more income, systems for acquiring cash-flowing assets, and systems for using new technology. It's a proactive approach to building wealth that looks a little different from the strategies of the past. Section 3. The Portfolio Myth. The old rule: stick to a safe mix of stocks and bonds. The classic investment advice for decades has been the 60-40 portfolio, 60% in stocks for growth and 40% in bonds for safety. You were told to buy blue-chip stocks from big, stable companies and avoid anything that seemed too complex or risky. But many young investors feel this model can be improved. Some studies show a growing belief among high-net-worth individuals under 40 that it's harder to get above-average returns by only investing in traditional stocks and bonds. In a world of low interest rates, the safe 40% in bonds doesn't always provide the returns or the protection it once did. More importantly, by sticking only to public markets, investors can miss out on the huge growth happening in the private sphere. The new rule: embrace alternative investments. The playbook for the new generation is built on diversification far beyond just stocks and bonds. While older investors might have over half their portfolio in public stocks, younger millionaires tend to allocate less, freeing up capital for what are known as alternative investments. We're talking about private equity, venture capital, and direct investments in startups. This could mean angel investing in promising tech companies in fields like AI or fintech. It's about owning a piece of the next big thing before it goes public. These investments are riskier, but they offer what's called asymmetric upside, the chance for one small investment to return 10x, 50x, or even more. Beyond that, their portfolios might include cryptocurrencies, collectibles like fine art, or other non-traditional assets. They understand that real wealth is often built in markets that are less accessible to the average person. The how-to: start accessing the alternatives market. So, how can you start exploring alternatives? First, education is key. This space requires more homework than buying an index fund. Start reading about venture capital and private equity to understand the risks and timelines. Second, explore platforms that are making these investments more accessible. Companies like Masterworks allow you to buy fractional shares of fine art, while others give you access to pre-IPO equity in major tech startups. You can often get started with just a few $100s. Third, consider allocating a small, fixed percentage of your portfolio to this area, maybe 5% to start. This is your high-growth bucket. It's money you can afford to lose, but it has the potential for huge growth. The key is to start small, learn the landscape, and gradually build your exposure to the asset classes that have the highest potential for creating wealth. If you're watched this far, be sure to hit the like button and subscribe. It signals to the algorithm that we're delivering real value and ensures you won't miss the rest of our wealth-building strategies. Section 4. The Mindset Myth. The old rule: invest domestically for your retirement. The final myth is about mindset. The old way of thinking was often stuck in your own backyard and focused on a date way, way off in the future. You invested in your home country's stock market because it was familiar. The goal was retirement, a fuzzy concept decades away where you could finally stop working. This approach ignores a world of global opportunity and ties your financial freedom to a specific age. This domestic bias is fading. Younger, high-net-worth investors often have a global perspective. They grew up connected and are more likely to invest overseas, seeking growth in emerging markets and diversifying across different currencies and economies. And their goal isn't just retirement, it's financial independence, and they want it as soon as possible. It's not about stopping work, it's about having the freedom to work on what you want, when you want, from wherever you want. This reframes the entire purpose of investing. It's not about saving for an end date. It's about building a system that gives you freedom and flexibility now. They also increasingly align their investments with their values, putting money into sectors like sustainable energy and social impact projects. The how-to: adopt a global, freedom-focused mindset. Adopting this new mindset is maybe the most important step of all. First, globalize your portfolio. This is easier than it sounds. You can start by adding a low-cost international index fund or ETF to your holdings. This immediately gives you exposure to thousands of companies around the world. Second, redefine your financial goal. Stop thinking about retirement at 65 and start calculating your financial independence number. This is the amount of capital you'd need to generate enough passive income to cover your ideal lifestyle. It shifts the focus from an age to a concrete financial target, which makes the goal feel more real and actionable. Third, start aligning your investments with your interests. Passionate about clean energy? Research ETFs in the renewable sector. Excited about AI? Look for funds that invest in leading AI companies. When you invest in what you believe in, you're more likely to stay engaged and hold for the long term. So, let's recap this new playbook. It's not about throwing out the old rules entirely, but about adding powerful new layers to them. First, focus on boosting your income so you have serious capital to invest. Second, consider treating real estate as a cash flow business, not just as a home. Third, diversify into alternative investments where explosive growth can happen. And finally, adopt a global mindset that's focused on achieving financial freedom sooner rather than later. This is a different philosophy of wealth. It's proactive, it's tech-savvy, and it's designed for the world we live in today. The path to building wealth isn't a secret. The strategies are out there. The only question is, are you ready to add them to your map? If you found this breakdown valuable, make sure you hit that subscribe button and turn on notifications so you don't miss what's next. And check out this other video on screen now where we dive even deeper into building high-income skills. Thanks for watching.